Welcome to Power Charting. I am your host, Bruce Frazier, and we have a very special guest today, Joe Turner. And I have a question that I've been really wanting to ask him for a while now. Is inflation a problem for investors in 2024? And the thing is that there's no better person to ask this question of than Joe Turner, who had a 50-year career in financial markets and is, in my opinion, is one of the top business cycle investment strategists on the planet. And during I think it was in the 80s, he taught a number of times, he taught a business cycle investing graduate course at Golden Gate University, which was hugely popular, well attended. And in this, he really revealed the skill sets that are required to being a successful manager of stocks and bonds and other assets through a business cycle. And with that, Joe, thank you for being here.
Well, thanks, Bruce, for the invitation. We've done a few of these over the decades, and I hope, I hate to remind you how old you're getting as well. But anyhow, experience is good.
All right, so Houston, we have a problem.
Well,
this is an inflation index. This is the Fed's favorite inflation indicator, personal consumption expenditures, PCE, and we have this going all the way back to 1960-ish, and and we can see that throughout the 90s, mid 90s to 2020, inflation was just really benign through that whole period, and now all of a sudden we've got this big bulge, and you have here, Houston, we have a problem. Well, what's the problem, Joe?
Well, the title of of today's issue is inflation a problem in 2024? And the short answer is yes, but I would add 2024 and beyond, because we might have a bigger problem than just inflation in 2024. And that's really the question out there. Because if inflation, this is not just a one-off and a little blip here, and we go back down like we did for the 30, 40 years beforehand, where inflation is less than 2% or thereabouts, we might have a return, something similar to what we had in the 60s and 70s. And I think that's the real question out there, because if everybody's going to need a new playbook or dust off the playbook that worked for investors back in the 60s and 70s, because inflation, if we're returning, creates a whole new set of decision-making process and tools.
And of course, I'd like to point out that Joe was around through the period of the 60s into the 70s, late 60s into the 70s, and was in this, if I'm not mistaken, Joe, was a large part of the reason that you became such a capable and successful investor, using the business cycle as your metaphor for investing and how to allocate dynamically assets through business cycles.
I was actually a natural-born financial genius, Bruce, until I got whacked with the first bear market. And then started asking the question, what moves? Why do financial asset prices go up or go down? And certainly inflation, business cycles and inflation are two of those biggest weights. I was going to say, highlight a time period that this may be similar to.
Well, and the thing I was just going to add is that from the late 40s into the 60s, didn't we have a relatively benign inflation environment? It was like low, stable, steady inflation throughout that decade, more than a decade, really. And then things started to ramp up here in the late 60s.
Exactly. And you can see that inflation came in waves, and there was just some mismanagement by the government, the Federal Reserve, that, political pressures and so on and so forth that really created these waves of inflation. And that's the question and what we have to be on guard for, moving forward. So we have a precedent for this. So bottom line is just today's investors have got, little experience with secular and rising inflation. Let's
Well,
take a closer.
and let me just point out one thing that you pointed out to me earlier, and that is that this bulge here looks an awful lot like this bulge here, but the difference being that this current one actually went a little bit higher and then this peak over here, and they both then had a meaningful pullback. So here it went sub 3%. This is into the early 70s, and here we could go lower here, but if the Fed addresses the issue today in a similar manner that they addressed it back then is it possible that this last mile to get from 3% inflation down to 2, which is their goal, is a bridge too far? That the last mile is the hardest mile.
Absolutely. And for a closer analogy, Bruce, forward to the next chart, where we superimpose. Yeah, there we go. Looking at today's market, the light shaded line, that where you're looking at that 1960 to 80 period, the solid heavy line using a consumer price index now. And comparing that to what we've seen so far from 2000, the really low point would be during the middle of the pandemic, and then the peak there being 2022, early 23, peak of 9% in the CPI, and and it coming down. So the question is, if the Fed is already talking about the possibility of cutting interest rates when we haven't even hit targets, are we setting ourselves up for something exactly that happened back in the 60s, where inflation may not get down to the prior low, as inflation did not hit a prior low in 72, 73 versus 66, 67. We might be setting ourselves up for, if we lower interest rates too soon here, that we get another wave or flash of inflation. And that's the real risk, and some reasons why that may well be possible.
I
So
was just going to point out that this is how the inflation unfolded throughout the course of the 70s, is that it would just be, and this all coincided with the business cycle, as you pointed out many times. But let's keep going here because we have a lot of good material. So here is now go to stockcharts.com YouTube page, and you can watch the Martin Pring video that he and I did together here at the beginning of the year. And this chart, he explains it very, very well. We're not going to spend as much time on it as he does, but this is his chart. It's really in classic Martin style. It's a beautiful analogy or picture of what happened here's the 50s, and you can see this nice persistent uptrend. And then in the 60s, this is just S&P 500 prices, and you could see that they went sideways through this whole period here, and didn't make any progress for more than a decade. But these bear markets caused by recessions, you can see this coincides with the classic business cycle. And so you have bull trends and then bear trends, but the bear trends are bigger. And as a consequence, you have more of a sideways market in prices than an uptrend, because the stock market loves low, stable inflation. Earnings, better quality earnings easier for companies to be able to make money and be able to bring profits to the bottom line, et cetera, et cetera. But Joe, why is this chart so important for investors to study?
Well, history is always a great point, but one of the interesting things to determine out of this is not only do you see business cycle effects at work here, but you see these secular themes or trends. As Bruce just pointed out, you look at the 60s, 70s, and you have essentially a flat trading or a bear market, and then that's followed by this huge run from 1982 to 2000, where you have a secular bull market, and then a secular bear market, and then from 2009, low point, to 2021, you have 12, 13 years there of a secular bull run. And that's the thing to keep in mind here. In different forms or shapes, as Martin points out with his description here, we may be looking and the early stages of a secular bear market. And let me just show theoretically what a secular bear market might look like. So each one of the heavy dark green line is your secular trend. And of course, a secular trend is made up by several business cycles, several bull and bear cyclical trends. Martin refers to it as the primary trend. Like today, we're in a primary uptrend, but the question is, are we at or have we begun a secular bear market? Because if it is, we're looking, as Bruce just showed, 10, 15 years of a down market, as we experienced 12 or 13 years of a secular bull market. Every equity bull market went higher and higher. We had higher lows, higher highs. It becomes questionable in a primary or in a secular bear market. So let's take a look.
Well,
Sorry,
Joe, I was just going to add the comment that just like in an individual or a family's budget, when you have high and rising inflation, it really makes it harder to be able to, pay for the goods and services, things that people need in their families to be able to run their households. It's the same for businesses. Businesses, when prices go up, businesses have a more difficult time bringing earnings, quality earnings to the bottom line. It's more difficult to grow the business. And so as a consequence, inflation actually deteriorates earnings. And so this is one of the conditions that you get when you're in a long-term downtrend that is caused by ever higher inflation rates, is companies have a more difficult time being able to create quality earnings and cash flow. And that's going to be reflected in the way that these markets are going to trade. And that's the reason I think that you're saying that we need a different toolkit to be able to manage a period of secular rising inflation than we do during a period of secular benign inflation. And
you touched on phenomena, Bruce, that we experience all the time in secular bear markets. Not only, does like inflation mask, it's not true earnings. They're inflation, they're inventory earnings. And so the marketplace typically corrects price earnings ratios, down in a secular bear market. But
one of the things I was going to say, Joe, before we move on, is that we really want the Fed to conquer this inflation spike that we recently had. And even though we have a period now that mirrors the period of the 60s when inflation started to rear its ugly head, Chair Powell in the Fed has up to this point, to really the December meeting, has been staunchly anti-inflation, raised interest rates, have been shrinking the balance sheet, appear to have been doing and saying the right things. And so if they can continue to do that, is it possible that the Fed could in fact wring inflation out of the system much faster than occurred in the 60s?
Well, that's the $64 billion question, or 34 trillion, whatever debt
Could
level.
we as investors be able to identify that the Fed's doing the right things, or that the right things are happening in the economy, to suggest that we're not going into another 60s into the 70s? Is there a way to be able to see that things are different this time?
Well, there will be benchmarks and certainly a checklist of, are we going down the correct path or positive path to get inflation under control so that, the economy can keep growing in a non-inflationary world. That's my fear, is that the Fed leaves their discipline behind, as they did in the 60s. And so what it could result in is you do have these inflationary waves up there. And if we combine what we've been discussing here today of inflation plus a secular bear market, you put that combination together, and that's where we need the checklist, Bruce, to follow, because what you're looking at, the chart you're looking at now, are these secular trends that are adjusted for inflation. And you can see that combination of secular bear market with inflation is something that we have to guard against, or have an investment plan to cope with this type of environment. So look at the 60s now from an inflation adjusted perspective. And the same thing with the 2009 period. You adjust for inflation, as Martin points out in that interview, a typical, and we haven't had a lot of them, but they do go back into the 1800s, of these secular shifts between bull and bear. The typical reaction or bottom line that you get, a secular inflation adjusted secular bear market, results in about a 65% decline in market value over a 15 or 16-year period of time. That's the challenge that we have facing us.
So investors and savers have a new, really a new challenge, and that is that to protect the purchasing power of their assets, especially retirees, being able to maintain your purchasing power, which is going to be required to maintain standard of living, is going to really put the retiree and the saver in the role of trying to keep their portfolios from going down during these recessionary periods, or going down only begrudgingly in a little bit, rather than these big declines that you see in these, red obelisks, where you have huge volatility to the downside on an inflation adjusted basis. This becomes the job to be done. And it's a far different beast from the secular bull runs that we had, say, in the 80s into the 90s, the 50s into the 60s, or 2009 into 2021. So, the like we said, the toolkit changes.
And it affects everybody. It's not just investors, but everybody becomes poorer. Our entire standard of living is part of this, is lowered because of the wealth destruction that inflation brings with it. So yeah, you could look at the markets, and we could probably look at go back and dissect that period from from the 60s into early 80s, and live that experience, because we could be facing the same thing. You notice
Now,
I was
go
going to
ahead,
say
Joe.
that, keep this in mind. we made higher highs and higher lows in the S&P from 2009 to 2021. I don't think we went 12 months that we weren't making a new high. And
Yes, yeah, it's just such a beautiful, persistent advance, which
yeah,
came with a sub 2% inflation rate.
and now that inflation has come back in, the S&P made that high in that upper right-hand corner that's shaded in gray in November or December of 2021. And we're challenging that today as we speak. We're close to those old highs, but consider that if we just use the consumer price index, we have to be 11% higher today than we were at that peak in December of 21, because that's what consumer prices have. So rather than, I think that old high was a little over 4,800, we'd have to be closer to 53 or 5,400 on the S&P to be at a new high in real terms. And that's one of the terms, one of the buzzwords that we're going to have to learn anew, which is real versus nominal.
Well,
So
and understanding that it's real return and real maintenance of maintaining capital and growing it that is going to be the job to be done, which is a bit of an obscure concept. And I'd like to just put in a plug here for stock charts. And of course, Martin blogs at stock charts, and his work is second to none. Is that stock charts has just got the best toolbox and the best tools for being able to create the right methodologies for being able to handle the environment that we're going into. And so I think, and the bloggers at stock charts are incredible analysts, and people like Martin and David Keller and many others. And just that this is just a great place to be able to have the tools and develop the skills to be able to do this work. Now, moving on, this is a chart that you've seen this before. I've put this chart up many times in the past, but this is the actual Dow Jones Industrial Average from the 1960 to 1983. And this quite dramatic, actually, because we went from a trending environment to 1966 to a trading range environment. And in fact, the Dow Jones hit 1,000 in 1966 and did not get above and stay above 1,000 until 1982. And so now the S&P had a bit of an uptrend in it, as you saw from the prior chart. But Joe, this chart has bigger ups, bigger downs, more volatility. And what is the job to be done through the 60s into the 70s and 80s when you have an environment like this?
well, could you imagine, index funds did not exist back in the 60s, 70s, 80s. And but they've certainly become popular today. And just the idea that the market gives you all, if we look at the last 12 years, it's like, oh, the market does nothing but go up. So indexing is very popular. You just buy an index fund, hold on, you count how much money you made at the end of the year. Maybe you spend a little of it as you go along. But if we're back to this type of environment, what happens to an index investor here? Not only do they not make any money, but if inflation is going along, and if you look above the yellow band on this chart, there are numbers that start like in 1966, 1.58, and if you move over a couple of columns, you get 5, 429, 617, 914, 650, 1125, 1034. When you look at the 10 years ending in 1980, 1981, inflation that doesn't show up on this is nominal terms, but inflation averaged 8% a year for 10 years. So you definitely need something other than indexing. You need a whole nother bag of tools and approaches to investment decisions. One, because you have a very volatile market, there's incredible opportunities to protect capital when these periodic bear markets happen, and to grow capital when you have the subsequent bull market. So you have tremendous swings in price movements, even as you went nowhere for 16 years. So the job to be done is, how do we capture these opportunities? How do we protect our portfolio during these swings? And then add on, how do we do it in real terms? So there's a real challenge out there to be able to manage portfolios in a new inflation-adjusted world, and to be able to capture both these up and down swings in the marketplace. So that's the whole concept that we're faced with here.
And let me just put a point on that, in that these swings up and down coincide with the business cycle, which
Absolutely.
is one of the reasons you became such a business cycle analyst and expert, is because you understood that there was a sequence of events that occurs where business cycles and financial markets like literally dance together, and that really the job to be done was just to simplify this, is that you want to grow capital when the opportunities present, protect capital when times aren't so good, and just grow capital. This is the job to be done. And this is a very difficult thing to do. This is psychologically difficult, because nobody wants to own the markets down here at the bottom of the bear markets. And each one of those is a big bear market. Psychologically very debilitating. And to have the right tools to tell you the right things to do at the right times, very, very hard to do. And so what Roman and I have done is we have really tried to kind of take Joe out of retirement. And by the way, it took $328 in 1983-84 to buy what $100 would buy back in 1960. So just to give you, kind of a dollar benchmark for what happened over the span of that period. But we asked Joe to give us, and he's already done one of these for us, hugely popular, greatly received, is Trading Through the Business Cycle Part 2, the Inflation Era. And so this is coming up in February, and Joe is going to again regale us with his wisdom and knowledge of business cycles in this 3-session course, and talk specifically about how to identify and handle the business cycle during an inflationary era. And I really, really hope that the Fed can keep us, and the government and everybody that can have some influence, can keep us out of a high inflationary environment like we had into the 60s, into the 70s. But in case that doesn't happen, we need to be prepared. And Joe, your thoughts on this before we conclude?
Well, I think your description there a few minutes ago, Bruce, it sounded like, I came out with knowledge about, experiencing, making right decisions.
You didn't? You just weren't just imbued with this? I mean,
no, I was going to point out on that last chart that, the 1968 peak was 994.65. I think I got licensed as a stockbroker thinking I was a genius within that 0.65, and watched the market go down for the next year and a half and lose 35%. That's what started my journey to ask the question, what makes or drives changes in financial assets? And part of this, what you're talking about here, is part business cycle, it's part understanding inflation, what are the tools? What are the techniques? What do you need in your bag to be able to grow
Part
for that kind of
psychological
growth?
peak performance.
Oh,
How to make decisions under uncertainty and stress.
there's going to be so much stress out there that people are going to, that's one of the things. That's one of the tools you're going to need is to develop the emotional, uh, I don't want to say stability, but maturity to be able to fight, those feelings. And I tell you at the bottom, it looks real easy when you're looking at a chart and say, oh, you buy here, you buy low. Well, the emotional feelings you have at that point are despondency, fear, a stomach that's totally, arguing with yourself. So that it's an emotional cycle as well as anything else. And that's just why you need all the tools you can get in this new environment.
Well, let's hope the Fed can keep us out of it, and we'll certainly talk about that at the time. But because I get to help Joe do this workshop, but the uh, let's hope that the Fed has learned a lot from the '60s and can do it differently this time, because we all can benefit from that. But let's also be prepared for all contingencies. And so, with that, Joe, thank you so much for being here and sharing some of your experiences and knowledge about inflation, the business cycle, and so on. And uh, please come back in the future.
Thanks, Bruce, and thank you everybody for listening, and hopefully we put some thoughts into your mind about your process.
Take care, everyone.